All right, welcome to Finance Friday here. I'm Jerry, owner, founder, CEO of Wealth Dynamics, and I am joined here by Neno Aquino. What's up, Neno?
Hey, what's going on, Jerry?
I'm good. So we have a good course tonight. We're going to be talking about investing, right? So if you're watching tonight and you're on Facebook, it's good to see you. If you're on Zoom, it's good to see you as well. The topic is going to be investing like the top 1%. Now, before we dive into it, Neno and I want to cover a couple of things we go over every week. First things first, Neno, do you want to kind of cover our ground rules for the call tonight?
Of course. So a couple of ground rules, we go over this every single week. Number one is have a purpose for attending the meeting or the webinar here, whether live or later on as a recorded version. So there are going to be a few different groups of people here that are going to be viewing this. Number one, you could be a client. Number two, maybe you have seen us, a few times and you're trying to kind of figure out who we are. And number three, like you haven't seen us, right? And Bobby, this is a very good opportunity. Also, there might, from time to time, we do have a couple of individuals that don't fit any of those categories. Maybe it's just going to be antagonistic or whatever. Who God knows why, right? So those three initial groups, we welcome you, we acknowledge you, and if you have any questions along the way here, please feel free to drop them, as we're going to be intending to be helping you. Now, as we go along the way here, we're going to, number one, trying to make it very digestible so you can actually get this information and be able to apply it. At the end of the day, we need information that it is not only does it sounds good, but it needs to turn into some kind of application. So it gives me a result in my life. Okay, so it needs to be there. Also, we are going to be talking about here, like we have a gentleman, his name is Griffin. He's going to be in the chat here along the way. He's going to be reaching out to you to talk about this book right here, right? So as we talk about, we want you to be able to apply this information. Here's Jerry's book, The Blueprint to Financial Freedom. Ultimately is, sure, this is going to be a very good 30, 40, 50 hour for the next hour here. But at the end of the day, how can we actually later on, put all this vast knowledge here into application? Let's get on a call. Griffin can reach out to you, myself, whoever it is going to be. Okay. Needless to say, be a producer, not a consumer. What I mentioned to you, if you fit in those three categories, right? If you're a client, if you are someone new, or if you're brand new, totally welcome. And last thing here, it is going to share if this helps you, or even get a book, right? But maybe you don't know who we are, or keep coming, showing up every single week. At the end of the day, this subject, if we're going to be accomplishing financial freedom, it really is going to be resting on one of the foundation things, that it is going to be responsibility. Now, if I need to become responsible, right? What does that mean? Like, I need to actually take a higher level of responsibility. And if I'm going to reach this level, I need to be exchanging way more with people, right? Beyond myself and beyond just my family. So those are giving me some of the ground rules here. And I want to keep it short today because we have a very good subject that we're going to be diving in.
Awesome. And I just want to hit one more time, like Neno said. So if Griffin reaches out to you in the chat, check your chat. Definitely don't be that weird person that sees his comment and pretend that like it didn't happen. So his goal is to connect with you. If you're not a client, we would like to get you a copy of our book tonight. Okay. So you can get this copy from Griffin. A lot of what we're covering is in this book. I'll be going over a little bit from the book itself. You're not going to get everything on the webinar tonight, right? So it's important, get what you can, get the book, get with Griffin, and he'll be able to get you set up with our team so you can get ongoing help and support, right? Now, before we dive into this, I want to go ahead and share my screen so we can go over the presentation that we put together tonight. But the topic is investing, right? Now, like Neno has said, with information, it's cool to learn stuff, but if we don't actually get a result, like it doesn't translate into something, then what is it we really learned? Right? Like we don't need needless facts on finances that don't translate. So we're talking about investing tonight, but we're not just talking about investing. We're talking about investing like the top 1%, right? Like it's one thing to invest. It's one thing. It's totally different to invest like the top 1%. Why would we want to identify and isolate that group in particular? Well, because they're successful at it. In this area, this is the most successful group. And so we don't want to invest like our brother-in-law. We don't want to invest like our coworker. We don't want to invest like the guy that we watch YouTube videos on that says to buy his Bitcoin. We want to invest like the guys that actually build wealth, right? And so that's why we're talking about investing like the top 1%. That's who we want to emulate. And on that note, we can't hate them and emulate them at the same time. Right. So whatever fixed ideas, preconceived notions you have about, being wealthy and rich, at the end of the day, if you want more options and more freedom, this should matter to you. Right. Like if you're like, hey, I don't want to have to trade my time for money at a job that I hate every day for the rest of my life. So then the weekends I can drive my German car to Olive Garden and pretend like I have a good life. If you don't want that, then you have to build wealth. Right. And so that's where it's like, okay, well, who has it? These guys do. So let's figure out what they're doing. We're not saying they're good people or they're bad people. We're just saying what they do works. Mathematically, it works. And so we're going to look at that math and we're going to look at how can we duplicate that math. If you think they're bad, you don't have to do the bad stuff. We're not telling you to block the sun or steal the water or, make people sick with vaccines. We're not telling you any of that. We're saying this is what works mathematically, right? So what I want to dive into first is what is investing. And this, I know, Nano, this is one of your favorite things to cover one-on-one with clients. Do you want to hit these points with us to start out?
Yeah, of course. In order for me to go, dive in about investing, I also need to understand the purpose, right? So whenever I dive in, and usually I was thinking about this today with clients, 101, right? I kind of break it down to them. Look, let's go ahead and ask a few questions. Now, whenever we take a look at the definition of the word invest, the etymology of the word means to clothe your capital, right? So whenever I'm clothing my capital, just like I'm clothing myself, a couple of questions I'm going to be asking. 1, do I like it? 2, do I understand it? 3, does it fit me? 4, does it match the occasion? 5, is it vital? And 6 is make sure that's not overpriced. So, I always use the example of a shirt, right? Look, obviously because I'm wearing one, but okay, I got to make sure that I
Thankfully.
Say that again.
Thankfully.
Yeah, I know, right?
We don't want to do shirtless Zoom meetings.
I know. So, okay, good. I like the shirt, polo shirt, pretty straightforward. I also understand, right? Yellow, straightforward. Summertime, Florida, all, fits everything. It also fits me. This is not too big, not too tight. Also, we match the occasion. What's the occasion? I'm doing a Zoom webinar here with Jerry and you guys, right? And it's vital, right? This is fits going to be vital for the occasion as well here. And it's not overpriced, right? I'm not going to be buying, at least myself, like a $400, $300 shirt, right? I'm going to be something that's not going to be overpriced. And
on this note, real quick, on this note of being vital.
Okay, go ahead.
This also has to do with sequence. Right. Like Nano was saying, like he's not going to, be buying, a $300 or $400 shirt if he's not wearing the basics. This also means you don't put your underwear on outside your pants. Right. Like a lot of people, we talk to them, they're like, I want to invest. And it's like, okay, well, you have $100,000 in credit card debt. Right. Or you're not earning more than you spend, or, you could be doing other things. And so the sequence isn't there. So I don't want to downplay investing because I invest. It's very important, but you would put your underwear on before your pants. You wouldn't put your jeans on and then put your whitey tighties over the top, right? So that's what we're talking about with vital is do the important things first. With investing, invest in the important things first, but also do them in the right sequence.
Yeah. And one last thing on this slide here is I got to ask myself the question, right? What am I trying to accomplish? Because just the very example of the shirt, right? If I'm trying to, for example, this shirt here, I like it, I understand it fits me, it matches the occasion, it is vital, I'm doing the right sequence, also not overpriced, but ultimately it matches the occasion, which is I'm doing a Zoom webinar here. If I was going to go for, join Jerry on a run, working out, cleaning the yard or whatever, even though I like this, even though I understand, even though it's not overpriced, even though it's the right sequence, it may not match the occasion. So I gotta ask myself the question, what am I trying to accomplish, right? And I'm going to let you digest on a little bit of this question as we're going to be unfolding throughout the webinar here. What am I trying to accomplish? Because this is gonna be vital. This, very fitting for tonight's webinar, but if I'm trying to clean the yard, probably not the best thing for me to wear.
Yeah. And I want to say on this point, something that I like and that I understand, right? So we're talking about clothing or capital. So I want you to picture you're walking down the street right now in a public place, fully clothed, right? And you're going along and you see these people and then boom, like that, your clothes are gone and you're butt naked on the sidewalk, right? I don't like that. I don't understand that, right? Like I would be confused. I wouldn't enjoy that situation, but this is what happens when you lose money. When you put money in crypto and meme stocks and all this weird stuff that people are investing in today, like that's the equivalent of it. Like that, boom, your clothes are gone. Your money just lost half its value, right?
And
You're
even
naked on
worse,
the
trying to
sidewalk
justify
financially. Go ahead, Nano. What'd you say?
it. And even worse, trying to justify it.
Yeah, you're naked on the sidewalk. You're not going to make sense. Like the only people you can make sense of that to are not the people you should talk to. Like anyone that's like, it's okay, man. This is totally fine for you to be naked on the sidewalk. That's not somebody you should be talking to anyways, right? Like it's not fine. Losing money is not normal, right? You're clothing your capital to have that gone in a day like that is not an okay thing. So part of this is changing our viewpoint and shifting what we think is normal, right? Because I can tell you right now, the wealthy aren't out there losing money, right? Like they're not out there putting money in speculations that they don't think are going to make. And if they are speculating, it's because they were already wealthy when they did it. We'll talk about that tonight too. Okay, so like Nano had said, and he kind of jumped into this already. What's the purpose of investing? Now, there's four main ones. Okay, so for me, when I'm looking at this, the first purpose for me is preservation of my principal. What does that mean? It means that I put money into a deal. Let's say I put 100 grand into an investment. My first objective is to not lose that 100 grand. Right? Like people overlook this. Like the number one rule of investing, you can look at Warren Buffett and all these guys, they'll tell you don't lose money. Right? Mathematically speaking, when I lose money, like if I have $100, right? I lose that $100 and it goes down to 50. Right? That's a 50% loss. Right? So I have a 50% loss, but guess what? A 50% gain only brings me back to 75. I have to make twice the return to get back to where I was, right? So we're like, oh, I'm making great returns. Okay, cool. But are you losing? Because if you're losing, you've got to make double the return of the loss just to get back to break even. You're not even profitable yet. It's too expensive to lose money. It takes too much time to lose money. You don't have time, right? So you have to look at this and look at, okay, if I don't have time, like what I mean by that is like, I'm trying to do this quick. I'm not trying to make this a 30-year deal. I'm trying to make this 5 years, 10 years, 15 years. I can't afford to lose money, which means anything that looks like it might lose me money in the realm of investing is my literal worst enemy. Like that's my arch nemesis. That's the number one thing that will prevent me from getting where I need to go. We can talk all we want about taxes. We can talk all we want about inflation, about the government, about the president. If you're out there losing money, it's worse than all of that. Right? And that's self-imposed. We did that to ourselves, right? So preservation of principle. The next one is income. Okay, income. My marketing guy sent me this company. I don't even know the name. It's not even worth mentioning the name if I did know. But they have like $25 million a year in income, and they're valuing themselves at like something ridiculous, like $300 million. Like you look at like that much income, and they have this giant valuation. The income doesn't add up. So when I invest, the main thing that I'm looking at is income. Why would that be? Nano, you talk with clients about all this all the time. Like, why income investing?
Well, number one, it kind of goes back to some of the basic laws, right, of wealth. I need to be in a position where I'm actually saving 40% of my income, right? So I gotta even going back to the vital question, right? Like being the right sequence. Where am I at in the position? Am I already financially free? Am I trying to get there? Am I trying to be pay off debt? Am I trying to do my first deal? It all depends. So I'm actually trying to get myself in a position to have this main pinnacle in place, which is going to be this 40% savings rate. So if I'm not able to do that with my current income, I need to actually have an investment that it is going, number one, not lose money. And number two is going to operate from a scalability standpoint that's going to produce revenue so I can actually start making all these little extra drips to be then in a position where I can save 40% of what I make.
And this is so important, guys, what Nano's saying. I'm going to draw a hard line here because this one is mandatory. This one is mandatory. These two are not. Right? Like no matter what, I don't want to lose money. No matter what, I want income from my investments. I'm okay if they don't appreciate. I'm okay if I don't get tax deductions, right? But if I lose money and it doesn't pay me a check every month, that's not a good deal for me because it doesn't help me achieve my goals and dreams. My purpose is passive income greater than savings, expenses, and taxes. And so if it's not helping me do that, then I don't want it. Like it's not something that matters to me. So I want to have the preservation of principal. I want to have the income, the appreciation. That means that the price of the investment could go up over time. That might be based on income. It might not. Tax reduction is another one, right? The reason why these are optional is I can get appreciation elsewhere, right? It doesn't have to be with my investments. I could stick the money in my sacred account first, and that's going to give me appreciation, then borrow against it and do the income investing. So I can literally build appreciation into whatever I want to build it into. That's the beautiful thing about being my own bank, right? Same thing with tax reduction, right? Like if I really want to reduce my taxes, I'm not going to do a real estate deal so I can get accelerated depreciation and maybe write off 50 cents on the dollar. No, I would rather put it into, a charitable remainder trust where I can write off the entire thing, right? Or put it into a solo 401k, or put it into a pension trust, all sorts of different things that give me tax deductions. And I'm not married to the tax deduction because of the investment. Okay. So usually, like when I'm looking at this, I want preservation, I want income. Really, for me, if I was going to pick one of the two, I think tax reduction for me does it more than appreciation. And the reason why is it's guaranteed, right? Like if I can reduce my taxes, that's factual. Like I know for sure. Appreciation is not guaranteed. It's like, well, maybe it will go up. Hopefully it goes up, right? But I don't like mixing hope and investing together. I want to know for sure what's going to happen. And that's, for me, if I can reduce my taxes by 25%, that's a definite rate of return on my investment, right? Anything else to add on this one, Nano?
Yeah, for sure. So one of the very first things that you mentioned as far as having the preservational principle is now, this is assuming that I already know the purpose. I already stand knowing that I need to save 40% of my income. So to even cut a gradient a little bit further is the very first thing that I need to watch out, right, is making sure that I don't make a mistake. And one of the biggest mistakes that I can make as an investor is not understanding the purpose, not understanding how to measure, and not understand what is going to be, how it's going to be playing out for me, right? I need to have that in. So, okay, good. Let me make sure, put in like in different terms. As I'm hitting the gym, I'm not coming home and stuffing myself with ice cream, right? Because if I'm like, yeah, I'm going to invest, and then I'm like, have this fixation, okay, it needs to give me tax reduction. It needs to give me appreciation. When like, okay, do I even have my 40% savings in place, right? So I got to make sure that the number one individual factor when it comes to an investment is making sure for myself that I understand how to measure it in the purpose of the investing.
Yeah, and I had an example of this actually. This is a real example of somebody that I was talking to, and they were looking at two investments, right? So on this side, they had an investment that was going to pay them a 12% cap rate. Cap rate means capitalization rate. That's the yield. So if I put in 100,000, it's going to pay me 12,000 a year in income. Now, this was a breakdown of 8% principal and interest, right? So I'm getting 12% on my money, like 100,000 goes in, I'm going to get $12,000 a year, or $1,000 a month is another way to look at it. Of that $1,000 a month, a portion of that is interest, like the bigger portion, a very small amount of that is principal, right? So this person was looking at that and they're like, okay, I'm going to make 12%, I'm going to make 8% here. The other one, and this is now, right? This is happening like this month. Okay. The other one was 4% per year now. And then later, maybe like 10 years down the road, projections of 15%. Okay. This is important. As an investor, I've got to be able to look at this, right? So I look at this and I'm like, oh, I see the number 15% a year. Oh, that looks better than 12. That looks better than 8, right? What I'm not looking at is, well, what money do I get today? When we look at these two things, preservation of principal and income, right? Like if we assume both of these are the same, where both of them are not going to lose money, then it's like, okay, well, which one pays me more income? This one. 4% a year is less than 12, right? I'm not looking at what's the total return on the deal. I'm looking at how much money am I going to get this month, because that's going to increase my savings rate. That's going to allow me to store more value. That's going to get me through my blueprint phases faster. Again, blueprint phases being what's in this book here, right? Step by step, the method of building wealth. So when I look at this, if I'm not educated, I might do the 15%, not realizing, well, right now I'm only going to get 4. 15 isn't even guaranteed. That's actually what's called a pro forma, meaning it's a speculation. It's not a promise of anything. It's not a guarantee of anything, right? So one of the first rules that I learned as an investor is more money now is always better than more money later, right? Like if I can get income today, that's better than income tomorrow. right? Income today I can use, I can create with it, I can make progress, right? So as you're going through this, that's one thing you want to be thinking with and looking at. Okay, now this is why we invest. Neno, you were kind of diving into this a little bit. Do you want to just connect the dots here on investing?
Yeah, of course. So for example, I need to have some of the basic foundations in place, right? We understand what the ultimate goal is. Ultimate goal is ideally I am financially free. I have enough passive income to cover my saving expenses and taxes. But before I do that, I need to save. Before I save, I need to earn. When it comes to savings, ideally I am doing 40% of my income. If you are a client, if you're a person that just seen us for the first time, or even if you're here with us for a while, you probably understand this, as I have covered this with you. It does not mean that we start there. If you start there, fantastic, right? It kind of puts you in like a very good position. But realistically and statistically speaking, most people are not going to start there. And there's going to be a sequence of steps that we're going to be helping you earn using like your sacred account, for example, to start financing your own things, purchasing your own debt, to start then increase your savings rate. But then, right, I do see that one of the biggest corners on the triangle and the one that has the most impact immediately is my earning. The more that I can earn, the more that I can save, which means consequently will be the more that I can invest. But if I'm bypassing some of this, let's say, oh, I have this money saved up and I want to invest, but I'm not earning, like I got to understand what is the purpose of an investment. The purpose for an investment is to, number one, to produce the scalability of my income. Right? So if I'm not earning, like if there's something goes wrong with the investment, as all investments have risks, then it's a problem, right? So I got to make sure all those corners are in place. And as I expand one, everything else is able to be expanded at the same time.
Yeah. And what I see happen a lot is, people they're out there doing aggressive investing and speculating usually don't know how to earn income. Right? Either they're unable or they're unwilling to, meaning they lack knowledge or they lack just like the work ethic to do it. And there's this myth out there that active income is bad, right? I can tell you my best income sources are active and I have no problem working, right? Like I can grow my active income so much faster than my passive income. And my active income, when I do that, like Neno's saying, I'll be able to save it. That helps me invest and that helps me bring in more income. And then I can start offsetting my active income. Right? Like I've used the analogy of like being in jail, you're digging out, right? You can't teleport. Like that technology doesn't exist yet. So you have to take steps to the yard and then you've got to get your little shank and you got to start digging in the dirt and you're going to get dirty and you're going to sweat and you're going to maybe get caught by the guards. And like, these are all real things. If you're doing this, you're going to work, you're going to trade some time for money. That's part of it. You're going to save, you're going to go without some things. And when you're investing, like Neno was saying, what's the purpose? Right? If I'm saving and I've only got $10,000, I don't need to be thinking about putting that into a real estate deal. Like that's not enough money to put into a real estate deal. So what do I invest this in to grow my active income? Is there a book I could get? Is there a course I could go to? Is there an event that I could attend? Like, is there coaching I could get? Like things that actually will grow my active. It doesn't all have to be passive. Now, once I get up to the range of like, okay, now I'm saving and I'm getting like 50K and more. Yeah, by all means, now I can start to invest in things that produce income and they're actually financial assets. But how do I get there? And that's where a lot of people, they overlook. And it's so crazy to think about. But if I'm willing to put money in crypto, if I'm willing to put money in stocks, if I'm willing to put money in real estate, like all things that I don't actually control at the end of the day, but I'm unwilling to invest in my own skill sets, what does that say about my belief in myself? Right? And am I really going to be financially independent with my thinking that way? Right. So I wanted to hit that real quick. Neno, you had something you wanted to add.
Correct. So if I'm trying to actually skip one of those corners, right? If I'm trying to have 10,000 and not so much focus on the earning side, what's probably going to happen is I'm going to start looking for unusual solutions. And what would be the usual solutions? Who is winning? The top, topic of tonight's webinar, like 1%. What are they doing? Right? You gotta earn, save, and invest. Like as simple as that sounds. But if I'm trying to bypass something, right? Well, let's say I don't know how to earn enough income, or if I don't have the skill set, it's very easy for me to make that wrong. Oh, I don't need that. Right? Let me go ahead and now start going to hoping and speculating. So that's one of the things to have in place. At least from the mindset standpoint that you just brought it up, is I need to have that very clear for me. Otherwise, I start looking almost like not going into a straight line. Okay, I gotta earn, I need to save, then I need to invest. If I'm not doing that, I'm now gonna start looking for unusual solutions.
And that's a great point to bring up. Unusual solutions. If we just look at that word, like what does that mean? We have two things there. We have usual, right? Now I have to realize for me, when I first started, I didn't have usual solutions because I didn't have solutions. I just had problems. Like I just had financial problems. I had no solution. So there was no, oh, I'm going to do the usual, because the usual wasn't a solution, right? So we have to look at, okay, well, what is the solution and what is usual? And that's where it's like, well, for most people, statistically, they don't have that. So then we have to look at, well, who does? Who has the solutions? Well, the ones that have the solutions are the ones that don't have the problems. What are the problems? Paycheck to paycheck, consumer debt, right? Losing money in investments. Those are the problems. And so we have to look at the people that don't have those problems, because that's how we measure whether or not someone has a solution. They don't have the problems if they have a solution, right? So like Neno said, it's top 1%ers. Those are the ones that don't have those problems because they have the solutions. So that's a usual solution. Then that would be the usual, right? Well, we're going to do the usual. So what is un? It means not. We're going to do the opposite. So anything that the top 1% aren't doing would be considered an unusual solution. Right now, when we look at this, it's like, okay, well, there's two different versions of this. There's what they're doing now after their top 1%ers. Then there's what they did to get there. Which one am I? So if I'm not there yet, then I don't do the things they do. I do the things that they did in order to get there. And that's what Nano is showing you with the book. Yeah. And real quick again, guys, if you don't have the book yet, reach out in the chat to Griffin. Okay. Griffin is going to send you a message. If you're not a client, Griffin's going to direct message you in the chat right now. Connect with him, ask about the book. This is going to give you everything you need. And then you can set up a call with them as well. Okay. So I wanted to hit that on the solutions because that's something that I think gets overlooked a lot. Go ahead, Nano.
Yeah, one thing that I want to mention on the book, right? Because for those that perhaps have seen us for the first time or, somewhat new, is this is not something based upon opinions, right? So Jerry, like, for if you're a client, like you already know this, but this is what Jerry has put together exactly from what the wealthy did in sequence in order to get where they are, right? This is not like, hey, like the 1%, right? What exactly did they do? So it's in here. So I just want to bring it that to, your attention now, the viewer, that this information is inside the book.
Yeah. And I always say this, you guys that are clients know this. Guys, I'm 30, right? Like you should, these shouldn't be my ideas, right? So it's like for me, I don't even listen to Elon Musk, right? I don't even listen to Bill Gates. Why not? Because they're not dead yet. They're not old enough. They could still lose everything, right? So the stuff in the book, Nano's saying, this is not my stuff. This is me spending over a decade of research looking at what did the top 1% actually do, right? As a financial advisor, this is what I was doing for a living. And I started looking at what did the top 1% actually do. And then I followed it and it worked because it's a usual solution. But this is not like we have to look at where we're getting our advice from on this stuff. Like a lot of times, we're looking at, okay, well, I want to take advice from Elon Musk. Okay, that's probably not a great guy to take advice from. I want to take advice from, the newest, coolest influencer I see on TikTok. You don't know the guy. You don't know what he's doing. You don't know what his assets are. You don't know what his income is. So who do we take advice from? We take advice from those we can actually get proof of success from. And the best proof of success is old, dead, wealthy people. And that's who I studied. So what makes an investment good? There's 4 main things here. Okay. 3 of these are non-negotiable. 1 of them is completely negotiable. Like we said, the first one is earnings, right? I want to see income from the investment. If it doesn't have income, this is something I'm never going to put money into, right? So that's my first one that's non-negotiable. The second one is track record. Okay. So for me, I like to see at least 5 years. So if I'm investing in a fund, I want to see a 5-year or more track record. If I'm putting money into, and I don't do stocks, but if I was going to put money in stocks, I want to see at least a 5-year track record of profitability, right? 5 years in a row where they made money, not 5 years total where they were overall profitable with some losses here and there. No. 5 years in a row where they made money. Okay. The other thing is I need to see that it has intrinsic value. Okay. Intrinsic value. It means that it actually is worth something innately. Right? Like it's got utility, it's got use, it's got, like raw materials, like no matter what, there's going to be value there. Okay, that's the third one that's non-negotiable. The fourth one for me is negotiable. And the reason why this one's negotiable is it's extrinsic value. What do other people think my investment's worth? There's a difference between price and value. Value is what it's worth. Price is what other people think it's worth. For me, I don't sell my investments, right? They're just not for sale. So I don't care what the extrinsic value is, as long as it pays me, as long as it has a track record, as long as it has extrinsic value. I don't care what other people think it's worth, because I know what it's worth to me. Right now, when people don't do these, this is where money gets lost. They're willing to, focus on extrinsic value. Oh, the share price went up. Oh, it's on, the price of the coin just, skyrocketed. It went to the moon. Okay, but there's no earnings, there's no track record, and it's not actually worth anything. It's a one-legged stool. You're riding around on a pogo stick at that point. Go ahead, Nano.
Yeah, so I actually want to clear up that word extrinsic because we're going to actually attach that to the purpose. Okay, extrinsic here on the dictionary means not part of the essential nature of someone or something. So not part of the essential nature. So what are we trying to accomplish here? It depends on you, right? And on your goals. Here, from our company, and what we're trying to help you is this. That's what we're trying to accomplish, right? So which means this is what? Not part of the essential nature. So it's not even necessarily essential to have this extrinsic value, because just as Jerry said, may or may not have it. But if I know I'm earning, if I know there's a track record and there's intrinsic value, I don't care what anybody else thinks, right? So I just want to define that word, because then I got to ask myself the question, what am I trying to accomplish? Which goes back to the question that we ask every week, right? What is the purpose of you attending the webinar? Which the purpose of why am I doing things, right? So anyway, so that's what I wanted to bring it up to this slide right now.
Yeah, and real quick, so in the chat here, it looks like David Riv is looking to get the book. Griffin, can you connect with David Riv? He's saying he wants to get the book and get set up with that. So if you could connect with him in the chat and send him the link, that would be awesome. Avery, I see your question. We're going to cover it in like 2 slides. So once we get there, if you've still got that question, let me know, and then we can pop on and answer it. So I want to talk next about my favorite types of investments. Right, there's a lot of them out there. These are just the ones that I like the most. Okay, and so I'm going to go through these in sequence. The first one is called secured private lending, right? And this is great. It's a passive income source. This is some of the first investing that I ever did. I still do it today. And basically, it's a way for me to get interest income. I'm loaning money out to a fund, right? And that fund is going to pay me interest. Right now, the interest is a loan, meaning like, they're borrowing my money. They're going to be using that to do whatever they're doing with it. It's the nature of their business, right? Whether that's buying, real estate, businesses, whatever. But they're paying me interest income, and I'm secured by the assets. This keyword secured, right? It means that if they don't pay me, I get to take an asset. Okay. I really like this type of investing because it's completely passive. Okay. This is the most passive form of investing I've ever done. Right? I don't have to manage anyone. I don't have to do the landlord thing. I don't have to like find the properties. I don't have to wait for vacancies. I don't have to do any of that. Right? Now, with that being said, it's something that I'm probably going to start with as a base layer. Then I might add some of these other things into it. Right? So the other one here is called seller finance. Right? Seller finance is very similar to secured private lending. Secured private lending means the fund buys the house. I loan the money to the fund so that they can buy the house. The fund pays me interest income from their profits. Right now, if they're not profitable on this first one, they still have to pay me. Right? If the person living in the house defaults and doesn't pay them, they still have to pay me. Right? So this gives me a little bit more buffer. Seller finance, I buy the house. Okay, I purchase the house myself. I then find the family, or I have a team that finds the family that's going to live there. They make a mortgage payment to me. Now with this one, it is still secured, right? So it's still the same benefit there. I could get a higher return, right? So I could get a greater return on my investment, but there's also more time involved, right? So like, let's think about this. If I buy a house, it's probably going to take some time for me to get someone to move into that, right? So if Nano purchases a property and he's like, hey, I want to put it on market, it might take 2, 3, 4 months before someone's living there. Right. The other thing too is if he's got someone living there, what if they stop making payments? Can he foreclose and take the home back? Definitely. But now he's got a vacancy. That might take 4, 5, 6 months to fill and get handled. Right. So I might make a higher return, but there's also a little bit more time involved in this. Make sense? This next one is called gold leasing. Okay, gold leasing means that I buy gold, like physical gold, and I literally lease that out to somebody. Usually it's going to be a bullion dealer, or it's going to be a jeweler, or somebody that sells gold for a living. It's part of their business model, and they're going to pay me interest basically to rent my gold, right? So they're going to pay me a percentage. This might be, 1 to, let's say, 4% a year. And that's what they're going to pay me. And then I still get the appreciation of the gold. You might look at that and you're like, okay, well, 1 to 4% is not a lot. Well, it's great when you're still earning 8 to 10 on top of that as gold appreciates, right? So that's a great way to take an asset that I'm probably going to buy anyways, and then put that to work to earn income. Foreign currency trading. We talked about this a few weeks ago. This is a great way to grow net worth, to increase the size of my net worth, get accredited. Life settlements. That's a great one for accredited investors. This basically is a form of somebody has a life insurance policy. They don't want it anymore. They'd rather have cash. So they sell it to me. I take over the premiums. I become the beneficiary. So when they pass away, their death benefit pays out to me instead, right? They're getting more money from me than the insurance company would give them. So they're getting like an actual benefit there. And then I'm getting a return on my investment at the end when they pass away at the time that policy matures. This is great again for accredited. And this is definitely a net worth multiplier, but it's also a non-correlating asset, meaning it's not parallel with anything. Like the stock market could be up or down. It doesn't matter. Life settlement's based on a person's lifespan, right? It doesn't matter what inflation is.
Jerry.
What's that?
Who tends to use a lot of the life settlements? That doesn't.
Oh, Warren Buffett and Bill Gates.
And they don't advertise a lot of that.
Yeah, Buffett and Gates do a lot of it. Like they're out there. And this again goes back to the who do you take your advice from? Like a lot of times, and I had a client text me this. He's like, hey, I was listening to Warren Buffett and he said da 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 da. And I told him, look, Warren Buffett is the epitome of do as I do, not as I say. Like watch what the guy does. Don't listen to a word he says. Right? He says, don't ever buy gold, don't ever buy silver. And then he makes billions of dollars on buying gold and silver. Right? He says, put money in the S&P 500. He doesn't do that. Right? He's doing life settlements and other deals. So this is a good one because it's non-correlating. So like I said, it doesn't matter what the stock market is doing. It doesn't matter what real estate's doing. It doesn't matter what inflation is doing. It doesn't matter what interest rates are doing, because my rate of return is based on somebody's lifespan. So that's where the payout comes from, right? I also do like oil and gas investing. This one is good for income. Okay, this one can be good for appreciation. Okay, but the main play here is tax write-offs, right? This is something, again, you have to be an accredited investor to do. But basically with an oil and gas investment, I can put money into it. This blew my mind when I learned it. If I put $100,000 into an oil and gas investment, I'm going to get income from that, and it's going to appreciate over time. But the year that I put that 100,000 in, I get to write off the entire amount against my income. So if I made, like 400 grand, I'm like, hey, I want to like reduce my income by 100,000. I could just take 100,000 out of my sacred account, stick that in an oil and gas deal. And now my taxable income has gone down by 100 grand. And it's still paying me income, and it's still appreciating on the back end. Right. And then there's residual tax benefits there too. And then finally would be private equity. Private equity is where I start buying small businesses, right? This is after I'm already accredited. This is after I've already achieved passive income greater than savings, expenses, and taxes, right? And this is where I can start looking at, okay, well, what do I like? This becomes much more the focus of investing. We talked about clothing our capital, right? What do I like the most? What am I interested in? Because I'm already financially independent at this point in time. So now I can be like, man, I've always wanted to own a coffee shop. I like coffee. It's something I understand. I'm going to find someone that already owns one, and I'm going to invest in their business. Or I really like car repair. I really like barbershops, whatever that might be. And then you can start building a portfolio of companies that you invest in as an equity owner, a silent partner. You're not going to go show up to work there every day, but you take the profits home. Right? So these are the kind of investments that are out there. These are my favorite kinds. Nano, did you have anything you wanted to add on this page?
No, this is just like I'm just paying attention here to what you're saying, and I was actually helping out a few people here on the chat because they had trying to get how to get the book.
Okay, good. And then let me check out some questions here. Let's see. It looks like Nano's connecting with some people here. So if you'd like to get the book, reach out to Nano in the chat, and he can get you set up with that. All right, we have a few questions. So let me go ahead and just answer some questions first before we jump onto our next slide. So first question looks like it's from. Looks like it's from Avery. Let me bring Avery on because we did kind of cover this just now a little bit, but I want to see if we answered his question. All right, we're mic'd up and live with Avery. How are you tonight, Avery?
Nano, Jerry, what's up, fellas?
What's going on,
Hey,
man?
it's good to talk to you. So I saw your question. Did we answer that or did you have more to that?
Yeah, I think you pretty much answered it. I would say the follow-up question to that is, now, let's say you do go more down the private equity route and you're able to go in and operate the company on your own. Let's say you have the proper skill sets to do so, yet you still haven't reached PI greater than set. Then what if you go into a company and want to earn profits out of the company as the owner instead of equity?
So that's more of like a business ownership role, right? Because then you definitely are trading time for money. I do that with my business, so there's nothing wrong with it. I don't consider my company my investment, right? It's more like this is my business versus like, let's say that Nano and I decide that we want to go buy a Brazilian barbecue place, right? A Brazilian steakhouse. And we're like, okay, cool. Like Nano can definitely cook steak, but we're not going to put Nano in the kitchen, right? We're going to hire chefs. We're going to put our capital into the business, but we're going to have other people doing all the work. So a really good person to study on this, Avery, is Warren Buffett. Just from the standpoint of how he looks at buying large companies, he looks at it just like buying a business. And one of the first things he looks at is obviously the financial statements. The second thing he looks at is management. Who's managing the business, right? Because it's not going to be him, right? So that's where you want to look at that. Now, if you're looking at it just from a pure, like, I want to just grow my income standpoint, owning a business can be a great way to do that, right? If you're willing to put the time and the effort into it. It's not passive at all. Anyone that tells you that is full of crap. Like, it's definitely an active venture, but it can definitely be very profitable and very rewarding. So that's definitely, my take on it. Good question there. So let me see what else we have for questions. And guys, again, if you're watching and you have not gotten a copy of the book, Blueprint to Financial Freedom, reach out to Nano in the chat, drop your name in the comments. Let us know you'd like to get the book. You do get the book, and then we'll also do a free call with you. You can talk with my team, get some consultation, some coaching on what you should be doing with your finances next. Again, that's Blueprint to Financial Freedom. Reach out to Nano in the chat and he will get you set up with that. Okay, looks like we have a question from Mark Perry. Let me bring Mark on. All right, we're live with Mark. How are you tonight, Mark?
I'm great. How's it going, Nano and Jerry as well? My question is in regards to a private lending deal where I'm loaning money for secured private loan on a first lien property. How necessary is it to actually have a physical copy of the deed on the property? What are your thoughts on that? Thanks.
Yeah, good question. So if you're literally doing it like direct to the property and not via a fund, for me, I would like to have the deed, right? So, I would get a copy of that. I would get a copy of everything I possibly can get, just because it's just me and the property. Now, if there's a fund, I can do UCC filings and other things of that nature. But for me, if it is a property, I do want a copy of the deed. And there's really not any reason why they wouldn't give me one, right? If they have it, let's copy it. Let's get me one. And then we can both have one. Okay. RCJ Pro, that lost me Forex. So Forex is foreign currency trading. Foreign exchange is what that stands for. We won't dive into the depths of that tonight. We did a webinar on that about 2 weeks ago. So if you reach out to Nano, he can get you a copy of that webinar. But that's a great way to grow your income. It's actually a form of trading currencies one against the other. And it's been around for quite some time. All right, a couple questions on how to get the book. So again, to get the book, reach out to Nano. Okay, reach out to Nano in the chat and you can get a copy of the book. I think he's dropping the link in the chat as well so that you can order and get your copy. And again, that does come with a free coaching call, a free consultation.
Griffin's also reaching out to you as well.
Yeah, Nano and Griffin are the two people that will be able to help you with that. Okay, good. I see a couple questions on Facebook. So let me answer some Facebook questions next. So Justin Goff says, I don't know if Jerry's talking about some of my past investments, but that 15% IRR and get 4% now was not a good idea. I prefer much the investments now that I have to WDX pays 10% allows me to reinvest the income sooner. Exactly. So Justin, and I wasn't talking about Justin, but Justin is basically saying that he did one of those deals where it's like, hey, you know, you're going to get a 15% return, but right now it's only 4, right? Like to me, that's contradicting. Is it, which one is it, 15 or 4, right? I want to know. But because he's doing our deals instead, he's making 10, right? He's gonna basically be able to reinvest the income. Now, again, he's getting a 12% cap rate. So if he puts in 100 grand, he's gonna get $1,000 a month back. 10% is that interest principal split. Okay, we have a question on Facebook from Suzanne. What happens if the life settlement doesn't pay due to the person doing something that lets the insurance off the hook for paying it? So that's a great question. So that's called a contestability clause. Those generally expire after a couple of years. So with a life settlement, it's usually an older person. And so they're past that contestability period. So they could basically do whatever they want to do, and whatever method they choose to pass away by, or whatever happens to them, right? That's going to be something that's generally covered. So there is a risk of that, you know, if somebody's in that contestability period. Some policies might have exclusions as well. So those are all things like, as you're going through that, you obviously wouldn't go find somebody yourself and be like, hey, you have life insurance, let me buy it from you. You would go through, you know, a fund or an agency or somebody that does that professionally, so they can make sure you're covered and you're getting the right thing. Good question there from Suzanne, though. Andrew Davis with a question: with gold leasing, is there a set dollar amount of gold that we would need in order to lease the gold out? Okay, so that's a good question. Gold leasing, the minimum is 10 ounces. Okay, so you have to have a minimum of 10 ounces of gold. Right now, that's about 20 grand. And so that's basically where you'd start. As far as the blueprint phase, you know, you could do that on phase 2 or 3 or on from there, right? So this is really like, you're going to buy the gold anyways on phase 2. And even on phase 0 and phase 1, from the very beginning, you're buying gold. And this is one of the reasons we're so big on it. You're going to use it, right? You're going to get to that point of like, okay, I'm ready to start leasing it out. Well, you can't lease it out if you don't have it, right? You can't borrow against it if you don't have it. So I'm building it up. And then when I get to that phase 2 and phase 3, that's where I can start doing some gold leasing. Sean King, there's 2 types of investors, correct? Accredited and, okay, so there's actually 3. Right. So there's 3 different investor classes. There's a there's an accredited investor. This means you've got $1 million net worth or higher, right? There's a sophisticated investor. This means you've got $250,000 net worth or higher. You've done a track record of deals profitably. You've got the experience. And then there's a qualified investor, which means you're just, you know, you're solvent. You're ready to invest. You're solvent. You're educated. You understand enough to start getting involved. Okay, good questions there. So let's jump back into the rest of this now. And again, if you have more questions, feel free to drop those in the chat. So things that are not investments, right? Things that are not investments. Crypto is not an investment, right? Gold is actually in itself not an investment. Silver is not an investment. Life insurance is not an investment. A house is not an investment. A retirement account is not an investment. You can buy investments with a retirement account, but the account itself is not an investment. Annuities are not an investment, and land is not an investment. So these are all things, and I put these here because this is the majority of what most people today are calling an investment. And none of these things are, right? Look, so when someone says, I invest in, it shouldn't end with crypto. That's impossible. You can't invest in crypto. You can speculate with it, right? Someone says, I invest in gold. You can't invest with gold. It's not an investment. You can store your value with it. You could speculate with it, right? Like, I invest in life insurance. No, that's not an investment. Legally, you can't call it that. You can store money in it. You can borrow against it. You can do all sorts of things. You can't invest with it, right? A house is not an investment. That's actually an expense, right? Like, if a house was an investment, you would have to go to Wall Street to buy one, right? Like, it's not an investment. Or retirement account, like I said, that's literally just a tax code. to tax code. This is if you put your money here, you can get tax deductions and tax deferrals. That's not an investment. Annuities are insurance products. Those aren't investments. Land similar to the house, that's not an investment. Why do I bring this up? Because I listed on the prior slide some of my favorite investments. Right? These are the things that are investments that I like to invest in. On this page, this is what most people are doing today. Right? They're putting money in crypto. They're putting money in gold and silver. They're putting money in life insurance, homes, retirement accounts, annuities, and they're under the mistaken thought that those are investments and they think that they're investing. Okay, now the commonality between all of these, if you guys haven't spotted it already, none of these can pay you passive income. By themselves, none of these can pay you passive income. Right? Maybe you could say life insurance could because of the dividends, right? But that's again, not an investment. So you're looking at these and you're like, okay, well, I want to be financially independent. I want passive income greater than savings, expenses, and taxes. Well, this goes back to what Nano said on slide 1. What I'm putting money into has got to match the purpose, right? None of these things accomplish that purpose. So Nano, do you want to hit this one? This is like one of my favorite ones. And we've only talked about this one once or twice with people.
Yeah. One thing that I just want to cover real quick, Jerry, in the previous slide, you were talking about, you said that a house, it is not an investment. And if it was, a person will need to go to Wall Street. Something that I actually want to bring to people's attention is that the reason why Jerry brought that up is because in 1933, there was something called the Securities Exchange Commission that happened. At that point, right, now we're going to have this redefining of what an investment is. Now we got to have registered securities that need to be quote unquote approved by Wall Street, because what had just happened, the Great Depression. Now this is in place in order to quote unquote protect the small investor, right? The average investor. So the investments now needs to be registered, called registered securities, which the same individuals that caused the problem are the ones now overseeing the solution, the quote unquote solution. And with a verifying note saying there is going to be something called unregistered securities. They're only open to whom? Accredited investors. Which is, what are we trying to accomplish by doing all of this, right? Have this right here, become financially free. So once I am at that point that I am an accredited investor, now I have access to different things that it's like, it's not even there. It is just, they're unregistered. They left this open. Why? Because, hey, for you, the average person, let's make sure that you are protected. Let's make sure we have these registered investments here, that we are overseeing it. But for us, we're going to have access to the unregistered securities. So anyway, so I just wanted to bring that up because it was something that could be overlooked, and people may see, oh yeah, just a normal thing. But like, if I understand the history of who I'm quote unquote dealing with, if I just avoid the trap, I could be, it would avoid me lots of years to undo what they're doing, the nonsense.
Yeah, and again, it goes back to the unusual solutions, right? So we look at the usual, we look at the solutions, and these aren't them, right? With investing, this doesn't solve the problem. So this slide here, this is a great one. This is talking about, so this has got a couple quadrants. Okay, so we have the track record of the investor here, and then we have the track record of the investment right here, right? So those are the two different things you've got to look at. Is if I'm investing, there's an investment that I'm putting money into, and then I'm the investor. Okay, so if my track record as an investor is unproven, right, then it's even more important that I put my money into investments that are proven, right? So I want to be down here, right? I don't want to be an unproven investor putting money into unproven investments. That's uneducated speculation, right? Most of the people that lost money in crypto this year were quadrant number 1. Uneducated investors, no proven track record. They're putting money into investments that have no proven track record, right? That's stupid meets stupid, Dumb and Dumber, right? Like, that's a great movie. That's not a great investment strategy. So I want to look at, okay, I never do this for any reason. If I don't know what I'm doing, if I'm not proven, then I'm not going to put my money into things that also aren't proven. Okay. So if I'm unproven, then it's even more important that I put my money into things that are. Okay. This is foundational investing. So all beginners should start here. I do the basics. I'm not looking at the crazy ninja strategies and all this advanced stuff. I'm looking at what's the thing that's going to protect my money and then pay me passive income. And that's it. That's the only thing I care about. Okay, go ahead, Neno.
Yeah, so with this right here, right, it goes back to, you know, a previous slide that we're talking about. It's like, I can actually be the biggest hinderman when it comes to an investment. Me, the investor, the person who is uneducated, right? If I don't understand the purpose, what it produces, and what I'm trying to accomplish, which means what? Now I got to find a solution. So where will most people go to find a quote unquote solution? Oh, let me go ahead and go towards, you know, with a financial advisor. Now let me ask myself the question, what are they going to provide for me? They're going to provide me with what? With Wall Street products. They're not necessarily going to provide me with a solution. What am I trying to, if I'm looking for a help, it's going to be implied that it is because there's something I don't know. If I'm looking for help in finances, there's something that I don't know about finances. I got to ask myself the question, would a financial advisor provide me the help? The answer would be a no, right? They're going to be providing me with a product. Were you going to say something, Jerry?
Yeah, do they even have the solutions? It goes back to what are their stats, right? Like when I was a financial advisor, guys, I was 19 and broke telling you what to do with your money. I didn't have the solutions at the time. So anything I take from that financial advisor is an unusual solution by definition that that person is probably not a top 1%er. Otherwise, they wouldn't be working a job at Edward Jones.
Yeah, which is also something that is somewhat of a new concept, right? For 1970s, the financial advisor concept. But ultimately, right? So if I need help in an area, you know, one, I am lacking knowledge in the area, which means I should actually go acquire the knowledge. And when we say acquire the knowledge, what am I trying to emulate? I got to have it clear for me what I'm trying to accomplish. So if I'm trying to emulate the top 1%, what have they done in sequence? Because somebody who is super wealthy right now, right, who's like talking about buying multiple business, like, what about me? I have 100 grand, or I have less than 100 grand, or whatever my situation is, or I'm just starting. What do I do? And here, I'm going to mention the book again. Here's the sequence that Jerry has, you know, researched, like taking time out of the equation, literally use a research and put it in sequence. And then I can look at it and I'm going to come to a couple of conclusions after reading the book. You know what? This makes sense. Let me go ahead and apply it. Or this is not going to make sense. It's not for me. Or even this makes sense. And I'm going to go ahead and do it myself. And there are many people who have done this. I'm going to give you one quick example here. A guy that recently, you know, got the book, was a referral, and he tried to, you know, do some things on his own. And nevertheless, an example, like he ended up actually getting what he was calling a sacred account, which was a universal life insurance. And I had to show it to him. Look, this is not even the correct thing that you're trying to accomplish. I showed right there and then for him. And then just to say that, okay, good, you can actually get the information, but if you're a very able individual, can you go ahead and apply the information yourself? 100%. Is it better to have a team to help you? I mean, I'll let you decide, right? I know that I want people that have the knowledge, have like done this along the way and do this for a living. So I actually help this individual. I just want to give that piece of information to, you know, with what you're saying right now.
Yeah, absolutely. And guys, this is the third one. So this is, you know, if you're a proven investor, you should be doing proven investments, right? Like there's this weird notion that we have is like, okay, well, I've proven myself, therefore now I can go do something different, right? Like one of the most successful guys that I know with investing has been doing the same exact deal for 40 years. He has not deviated, right? So he's extremely proven. And he's doing the same thing he did on day one, 40 years in a row, right? Why? Because it's a successful action. Like look at like, you know, not a great food, but look at McDonald's. They're not out there trying new menu items. They've been giving you a shitty burger and fries for like 50 years, and that's all they do, right? And people love it. They line up. There's always people buying from them. They're proven, and they're doing a proven deal, right? Like why would I change it up if it works? Like if I change something, it's because what I'm doing apparently doesn't work. Well, if I'm proven and it's proven it's working, why would I change that? So this is the sweet spot. This is where most people should stay. Okay. Now then finally, you've got quadrant number 4. This is proven investor with unproven investments. This is educated speculation. This is done only after you're financially independent, and it's not even necessary to do. Like this is literally like you're bored and that's what you want to do for fun. Right? Like, okay, cool. I'm going to go do some day trading now. Okay, fine. If you lose all your money, you're going to be fine because you've got the passive income. It's not like part of the blueprint. It's not like a step you should take. It's kind of like, okay, you know, I have a car, normal. I want to do racing. That's not normal. Most people aren't going to race, right? Both drive cars, not both race. So you're here. It doesn't mean you have to do unproven investments. For me personally, I don't think I'll ever do that. I don't have any reason to. If one thing's working, why would I change it? Right? So that's what I want to cover here. Now, what are the steps we would take? So on investing here, this is the first thing, is to become qualified. This happens on phase 3, not on phase 0, not on phase 1, not on phase 2, on phase 3 specifically. This is where we invest, right? So when you're ready to do this, you know, you're financially educated, you've got no consumer debt, right? You're properly protected, you're solvent, you're not putting money in any of the traps with Wall Street, banks, and the IRS. You're saving as much money as you can. You've done everything you maximally can to self-finance all your stuff, and you're bringing in all your own income at that point. Now we go do the next thing, which is investing outside of my own economy. Like I'm bringing in another deal, right? But for the first 3 phases, I am the deal. Everything I do goes back into my own progress before I start doing other investments, right? And again, this is a viewpoint shift. You've got to look at, okay, well, I am the investment. Why would I go to other things before myself? Right? If I can reduce my own taxes through putting money towards tax planning, that's an investment. That's bringing me money back, right? If I can, you know, self-finance my car and then earn income on doing that, why wouldn't I? That's a sure thing, right? Now, once I am here, the next step is deal analysis. This is for our clients, the part that we make very short and easy. You don't have to go look at every deal in the universe. We've hand selected the right ones. So when you're ready to invest, we look at your goals, we look at what you're trying to accomplish, and then we've got vetted, proven funds that we've been working with forever that have track records. They've got, you know, intrinsic value, they've got income, all the things we talked about. We've already lined them up, and then you just decide, okay, well, I want to do this one or I want to do that one, and then we get you connected with the right people for it, so it saves you time, right? Like for me, I don't want to have to go underwrite a bunch of deals. Underwriting means I go look at them and I study a property, or I look at a balance sheet and I do all the nitty gritty to determine if it's a good deal. You look at a good real estate investor, they're going to look at 100 properties to pick 2. Nothing passive about that, right? That's a lot of work. So I look at the deal analysis. I decide which deal I'm going to do. I decide on the amount. How much am I putting in? I do a letter of intent. Then I go through the due diligence process and the closing process, and that's it, right? And so once I've done these, at the end here, I should have passive income. Okay. This step of actually doing this is very simple and fast. What takes the longest is the lead up, getting to phase 3. And this is where Nano coaches people all the time. This doesn't have to take a long time. Okay. A lot of people might drag it out. Some people might do it quick, but it's something you subjectively get through at the pace you want to get through. And so when you're working with our team, we're helping you get through those phases. We're like, okay, good. Here's what you need to do to get through phase 0. Okay. And whether you do those things or not, it's totally up to you. When you get on the phone with Nano again a week later, if you didn't do anything, you know, that's on you. Nano's got more people to go help, right? Nano, what do you talk to people about to get them through to this point?
Yeah, so ultimately they gotta have very clear for themselves, right? Look, this is the timeline, right? This is it's gonna take you to accomplish this. These are going to be the steps. We're gonna move at your pace. You want to go fast? By all means, let's do this, right? But if you're gonna drag your feet or take your time, right? Some things are going to be, by the nature of it, are gonna take some time. Let's say, for example, just because I signed up for a sacred account today does not mean that I'm gonna deposit the money in tomorrow, right? But that also does not mean that I cannot become educated, right? So a lot in the beginning, it is going to be heavily focused on education. So by the time that we actually get on a call to start pulling triggers, I'm not actually operating with data that it's not the usual solution. Meaning, if I am trying to accomplish this statistical achievement by the top 1%, I actually need to think how they think and be using the same tool that they are operating. Which means if I have not been using it, then I need to become familiarized with what they are, right? So I'm very, heavily focused on education and taking action. Because if I'm just going to be consuming education but not taking action, like, what's really the point? It needs to have an application. And then I give you a piece of information, and until something, sure, we can do concurrently at the same time in tandem, but at the end of the day, we gotta get the information and apply it.
Right. So that's kind of the process, guys. So when you're looking at this, like, we went over the action steps, and it really comes down to, like, where am I at? Right. and where am I going to get to next? If it's investing next, great. If it's not, like, I shouldn't look at that as a reason to not make progress. I should look at that as, okay, well, what do I need to do to get there? Right? Like, if it's that important to me, I'm going to make sure I get there. So I want to answer some questions really quick before we wrap up tonight. First question, quick one from Mark. What does UCC mean? So that is Uniform Commercial Code filing. Basically, when you're doing a loan, that's a filing you can do to signify that there is a loan against the property or a lien against it. What would you say about someone who talks about the S&P and returns and buying and holding over time? I would say they don't understand investing. It's like they look at it as like a video game instead of like, okay, well, you're buying the S&P 500. That means you own 500 companies. Think about this, 500 companies. You're telling me you've looked at 500 financial statements and you understand them all. And you look at 500 business models and you understand all of them. And you've vetted the executive team of 500 businesses and you like all of the people and you think that they're doing a good job and that you feel like you're in control of that. No, like nobody has done that. So I don't do the S&P because of that reason. Good. Okay. I don't see any other questions on Zoom. Let me check Facebook here and see if we've got any other questions that have come through on Facebook. Okay, good question here from Griffin is on both platforms with questions. This is awesome. He's omnipresent everywhere at once. Okay, Jerry, if they earn interest or make more than a savings account, why do you not consider them investments? Asking for a friend. I think he's talking about the sacred account. So by definition, life insurance is not an investment. So an investment, that's going to be a registered or unregistered security, and life insurance does not meet either of those definitions. Neither do bank accounts, neither do certificates of depression or deposit, whichever one you want to call it. Neither do annuities, like neither do homes. So those are all things that, they're not classified legally as an investment. So we can't call them that. They're stores of value. They're things that might go up in price. Sometimes you might even make a little bit of money off of them, but they're definitely not considered investments.
On that note, Jerry, because I do get that question asked from time to time whenever I'm presenting the sacred account. What I tell individuals is this is not your investment. This is your parking place until we're ready to invest.
Yeah. Yeah. It's kind of like being in the airport. Like, this is not your flight. You're just in the lobby right now. When the plane arrives, you'll get on, you'll go where you're going. But for right now, this is where you stay until that happens. Right. So, and with that being said, you can wait in like the nice Delta Sky Premier Lounge and get like good food and like a nice seat, or you can be like in the area where everyone's sleeping and snoring on you and you might get sick, right? So there's like the bank and the sacred account. Okay, so that's the difference there. I think that's all the questions that I see here on Zoom and on Facebook. So guys, one more time, if you have not gotten the book, and I did see a bunch of people did just get it, get the link from Nano. It's in the chat. You can go to jerryfetta.com/B2F promo. Okay, that's the letter B, the number 2, the letter F, the word promo. You can get the ebook. You can get that for $2.99. There's no shipping or anything like that. You can get the physical copy for free, $9.99 shipping and handling. And both of those do come with a free coaching call. Otherwise, we're going to go ahead and Jennifer likes the Delta Lounge. Thank you, Jennifer. Otherwise, we're going to go ahead and wrap up. Nano, you do have a call on Monday. What is your Monday call about?
It is going to be actually how the culture of Wall Street and actually how they work, right? This inflated numbers in the what's actually happening behind there, and how they actually make money. And one thing to point it out, like, what is the one thing for sure guaranteed with Wall Street? Fees, right? So I'm actually going to be diving in actually how that works, and for you to understand like in depth. Okay, if I'm having my money there, it is like showing up to the nice restaurant, quote unquote, they're being marketed, and seeing how the kitchen is cooking my dish, my plate, right? Not a good sight. So that's what I'm going to be diving in on Monday.
Yeah. So I had someone last week tell me they know someone that found like a finger in the French fries at a restaurant one time.
Yeah.
Right. So Nano's going to show you the finger in the French fries with Wall Street this week. That's going to be Monday, 4 p.m. Eastern time. We do not have Finance Friday next week. The reason why is we are going to be at Disney World celebrating with our team. So next Friday, we will be off. We might pop in for a quick live video, but it's not going to be a full course if we do that. Otherwise, we'll see you guys Monday. Again, get the book if you haven't already. Have a great weekend, and we will talk to you guys next time.
See you guys.